You know the drill. A bank fails, and everybody panics, right? We're basically programmed to think a bank collapse equals instant death for the real economy. Well, today, we're completely destroying that myth in this explainer. It's a terrifying narrative we all just casually accept. When banks start bleeding out, the businesses relying on them get dragged right down into the abyss. Cut off the money, kill the business. Sounds like basic common sense, doesn't it? But we're about to shatter that expectation entirely. We're trading in economic doomsday for cold, hard data. We're diving into an exhaustive study from the Journal of Financial Economics. And man, the reality on the ground during a massive financial panic was shockingly different from what the apocalyptic headlines told us. To prove this, let's take a trip to Norway. The years are 1988 to 1991. Norway got hit by a terrifying financial tsunami. I mean, we're not talking about some minor everyday recession here. This was a full-blown systemic crisis that nearly vaporized their entire banking system. Here's how it went down. Back in 1984, the government deregulated the financial sector, which kicked off a massive, totally reckless lending frenzy. By 1988, the first domino drops, a bank fails. And by 1991, it is sheer, unadulterated panic. The Norwegian government actually had to step in and forcibly take over the nation's top 3 commercial banks just to stop a total national collapse. The sheer scale of this disaster is honestly hard to overstate. It was absolute carnage. This crisis wiped out an astonishing 95% of all commercial bank assets in the entire country. Just let that sink in for a second. 95%. The banking sector was, for all intents and purposes, completely decimated. Now, common sense dictates exactly what should happen next, right? The companies borrowing from these dying banks should have just evaporated instantly. No banks, no business loans, no survival. But the actual data delivers the ultimate slap in the face to that whole theory. First off, consider the sheer damage to the banks themselves. From 1988 to 1991, publicly listed Norwegian banks lost over 84% of their entire equity value. They were in a catastrophic freefall, and investors were just frantically running for the exits. But think about this contrast. Researchers tracked stock prices in a super strict 3-day window right when the banks announced their distress. The bank stocks, they crashed by a massive 10.6%. But the firms borrowing from them, they barely suffered a scratch. They dropped a tiny, almost invisible 1.7%. The market barely even blinked at them. And okay, the data actually gets even crazier. Over the exact same multi-year period where those banks lost 84% of their value, the overall stock market of those borrowing firms actually surged 63%. No way, right? They didn't just survive the death of their banks, they literally thrived. So you absolutely have to ask yourself, how? How in the world did these businesses walk away from a devastating system-wide banking collapse practically untouched? Well, the researchers compared the financial traits of all these firms side by side to figure exactly that out. And it turns out the secret to survival wasn't magic. It definitely wasn't government bailouts. It was just basic financial hygiene. High cash flow, untouched credit lines. These things acted like the ultimate life vest, while their primary banks were sinking straight to the bottom. Let's break down the armor these survivors were wearing. Firms that had already issued their own equity before the crash, they had a massive buffer. Firms with strong operating cash completely ignored the fact that their primary bank was bleeding out. Honestly, cash is king, and unused credit lines literally save lives. On the flip side, we can clearly see the real victims in the data. The heavily leveraged companies, the ones that had already maxed out their bank credit lines, they took a massive immediate hit. And why? Because they ran out of cash with absolutely nowhere else to turn when the panic hit. But wait a minute, we definitely need to address a potential bias here. What about the companies that did leave their failing banks, got delisted from the exchange, and ended up collapsing anyway? Because yeah, some companies absolutely did fail during this time. It's incredibly easy to look at that economic wreckage, point a finger at the dying banks and say, hey, they killed these businesses by abruptly cutting off their money. It's a super convenient scapegoat. But is that actually the truth? Well, the data slaps us in the face yet again. The researchers specifically looked for this hidden bias by analyzing the firms that ended their bank relationships. And it turns out those specific firms were already operating with 5.8% lower profitability than the survivors. And get this, that was before the crash even started. Just think about the traits of these so-called victims. Already failing profitability, deeply negative pre-event stock returns, fundamentally weak business models. They were failing long before the banks ever stopped answering their calls. Actually, scratch that. The banks didn't kill them at all. They were already drowning.
And that brings us to the single most powerful takeaway of this entire analysis. It's a completely counterintuitive lesson that pretty much destroys everything we normally assume about macroeconomics.
Banking crises don't kill healthy companies. Seriously, let that sink in for a second. If a company manages its cash right and doesn't max out its credit, its primary bank can literally collapse into total ruin, and the company, it will just keep operating and growing like nothing happened. The terrifying, deeply ingrained narrative that a financial system failure guarantees some kind of complete economic apocalypse, it simply isn't backed by the evidence. Healthy firms survive bank failures easily. It's not a guess. The data proves it without a shadow of a doubt. So, the very next time you hear a news story panicking about a bank failure destroying local businesses, you really have to ask yourself one hard question. Were those businesses actually healthy to begin with, or were they just waiting to fail? Think about that, and I'll catch you in the next